Look at what central banks are doing all around the world. If they're the ones with the printing presses and they're the ones buying all this gold, probably means we as individuals should be buying gold as well.
Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira, part of the outreach team of Silver Bullion here in Singapore, where we want to help you truly secure your wealth. Gareth Soloway, President, CFO, and Chief Market Strategist from InTheMoneyStocks.com, joins us today. Gareth is renowned for his macroeconomic analysis, technical chart analysis, and trade signal alerts. He is a swing trader as well as a day trader and trades everything from stocks to commodities and even crypto. His success is world renowned with tens of thousands of followers coming from all around the world. And we're delighted to have Gareth join us once again today. It's time to saddle up and silver up for Gareth Soloway. Gareth, welcome back to SBTV. How are you doing?
I'm doing really well. Thanks for having me back.
Glad to have you back on. Gareth, I want to first start off with what we are seeing in precious metals, and basically both metals, silver and gold, they've been kind of flat for a while. From your trader technical analyst position, what are you seeing as the reason or reasons why both metals are kind of treading water?
Yeah, so that's a great point, is that we haven't really seen a lot of amazing action from gold or silver or even palladium or platinum. But I think the key is that the price action is actually much more bullish than it actually looks. And the reason why is if we bring up the dollar chart, this action here, we've had a very, very strong dollar since July, the July lows. And even going back, I mean, if you go back to 2020 or so, the dollar was a lot lower. And then if we flip over to gold, we can see that gold is very close to its all-time highs. It's not at its all-time highs, but it's very close. So the price action while treading water on silver and gold, if you actually include the dollar and what usually would happen to these metals, price action to me has been very, very solid.
Okay, that's a great point. And I'm asking this because we've heard for years the silver story about how we'll see a phenomenal silver price rise, and then we hear about inflation and how it should move the precious metals needle. And now we even hear about how industry is going to take up much of the silver supply for renewable energy, and that may leave investors with less of that silver pie. So even knowing these things, and despite whatever the dollar may be doing with its ups and downs, why is there seemingly no love for silver and gold or precious metals as far as price action?
Yeah, so I think it's multifold. So one of the main factors is that we still see technology stocks doing really, really well, right? The Nasdaq 100 has come back dramatically off the October lows, and so people are still saying, "Hey, I want to be in these risky assets. I don't necessarily want to be in gold or silver right now because yes, inflation's been an issue, but the Fed, everyone believes the Fed is bringing inflation back to sub 2%. I'm not in that camp. I think inflation's going to stay higher for longer. I think the Fed is going to have to fight it with higher rates for longer. And I think the market at this point hasn't come to that realization. And so still the tech stocks, for instance, an Apple or Nvidia, these stocks have run tremendously. And that eventually will start to come back in when we realize that hiking rates is going to stick around for longer periods. And I do think the metals begin to show their shine once that happens. But right now, investors are saying, well, where's my best bang for my buck? And price action is drawing them into the technology stocks. And even oil to some extent. Oil has been on a run recently, and we're seeing oil stocks doing very well. So the metals have kind of been left behind, but I do think they start to outperform sooner than later.
Speaking of oil, I think they just had some of the higher prices in oil in the past 10 months or so going on currently. You think that's going to move the needle for precious metals?
I do think eventually it will, and I think the way it's going to move the needle for precious metals is based on inflation, right? So we've seen inflation come down, and you look at 12-month CPI or month over month. Generally, it's been down until the recent last read, and that was when oil began to rally off of its lows here on the charts. And we now are seeing, like you just mentioned, you have a price on oil in September now that you have to go back to last November to find a higher level on oil. So as we start rolling over the 12 months, the last 12 months, eventually oil, the 12-month period, once we get to December, for instance, you're talking about a $70 price on oil. So the CPI year over year is going to start to go higher versus lower. So yes, we're still elevated on CPI. It's come in a lot, but you're now starting to see a lot of these commodities pick up steam, and that will make it harder for the Fed to cut rates again and print money later on. It'll keep inflation higher.
Right. So I guess what you would say that the market still has an appetite for risk, considering that they still believe that the Fed will be a backstop out there.
Yeah, I mean, there's this narrative right now out there that the Fed somehow is going to engineer this perfect landing. You know, they're even calling it a no landing scenario where we're just going to keep growing as an economy. And again, I just always push back on that and say, show me one time in history where the Fed has actually engineered a soft landing or no landing scenario, and they just haven't. They're always looking at backward data from periods ago, and they usually go too far one way or too far the other way, and it just creates this, they're always playing catch up. So again, you know, you're already seeing it with the labor market starting to weaken, economic data starting to weaken more and more, and then you throw in higher oil prices, higher gasoline prices, and all of these commodities, and it's just putting more and more stress on the consumer, right? We have $1 trillion plus credit card debt. We now see defaults on credit cards that are the highest since 2012. And so to me, I'm seeing like it's almost like a slow train wreck, very, very slow motion train wreck, but it is happening before my eyes, even though the mainstream media is not really talking that aspect up yet.
Yeah, that's very true indeed. Last week we had on your colleague Nick Santiago, and he brought up a pretty interesting point about how gold has hit that $2,000 level some three times, and he expects it to eventually break through. So I just kind of want to follow up here and ask you, what resistance levels are you seeing with gold for it to be able to break through to maintain that $2,000 level?
Yeah, so I think that's really important is that when we look at technical analysis, there's a high pivot which was right here in 2020. We then hit a double top. Double tops have big pullbacks. That's what we got here. And then you get triple tops. This is a triple top in technical analysis, and triple tops usually have shallow pullbacks before they look to break to the upside. So that's if you look at a textbook or if you look at past scenarios and charts, this is exactly what happens. And if we look here, we can even see how we had this downsloping yellow trend line pivot high to pivot high. We broke out above it to retest that high. We've then checked back here and then again right here. And then we have another trend line here, this downsloping one, which we just broke above. So it's a very slow period. We know that gold is not a crazy mover in terms of percentages, but slowly you're seeing level after level get broken to the upside. And I do think by year end, we're back to these highs and actually breaking through the all-time highs on gold. So I do see it going much, much higher, but it takes some time to break those highs. Once you see 2080 or so, that high on gold broken, a lot of new money will flood in, and you'll probably see a very big push to the upside.
Gareth, how about silver? What, in your view, is the biggest short term resistance number that silver needs to break through?
Yeah, so the biggest one right now is this one going back to the highs of around $30. We had this high, and then I still remember Wall Street Bets trying to pump it back here in February of 2021. That failed miserably. And then you have these other pivot points where you can just draw a trend line right back down. So if this one to me, this one that I stretch out, it's right around $25.50. That to me is the big one. Now you do have a little smaller one right here, which again is right at this level here. We obviously are pulling back in recent days off of that level. And then on the downside, you have two as well, right? So we can even remove this one, but we have this upsloping white line, which is currently around 2265, excuse me. And then this one down here around 20 and a half. So for me, I'm looking at what's called a wedge pattern, right? Where you have a big move and a lot of sideways chop inside of that. And ultimately, I expect it to break to the upside. Doesn't mean we can't go test the lower end, but eventually I think it breaks to the upside. And once we get through this 25 and a half level, you should zoom pretty quickly to that $30 level on silver.
If you're enjoying this interview with Gareth Soloway and I, please consider subscribing to our YouTube channel. And did you know that at Silver Bullion, you can collateralize your precious metals in storage and take out a bullion secured peer to peer loan while retaining full ownership of your metals? For more info, go to www.silverbullion.com.sg, go to P2P loans, and click on About. Okay, that'll be good to see once again. I mean, just kind of curious. I think a lot of us in the silver investor community, we've often wondered why has silver barely even smelled that $30 level since that Wall Street silver event.
Yeah, I mean that's a great question, and I think it's been a combination of that the environment we've been in. It's been one where industrial demand for silver is relatively strong, but investment in silver ever since the Federal Reserve has been printing money, and we're going back to 2009, 2008 here. It's that money has wanted to chase where the best returns are. And we've really seen, we know technology, we know the NASDAQ 100, we know stocks in general have been outperformers. And so there's kind of been this void in people's portfolios where they're not really heavily invested in metals. And you even have Bitcoin now and the potential for that to take some measure of that safety trade off. But I do think that eventually we're going to see that resurgence in the metals. And I still remember vividly going back quite a ways, back to the 2010, 2011 bull run, where this was just kind of meteoric. And what we could even see here is you could even go back to this period, and you had this pivot top right here, right? Little downsloping trend line, and you hammered it here, pulled back. We had this pretty big dip all the way down to about $8.75. We hit it again, and when we broke out, you had this big move from basically $19 all the way up to about $50. And so in many ways, you look at this period and it's almost the same, right? Here's your move up. Here's your 1, 2, 3. And my guess is when we do get that push, you literally could see a 1 to 2 year move that takes you back to $50 as a double top on silver. So again, we have to break out above this level. But again, just looking back historically, very similar patterns, downslopping trend line. But notice when the move started here, it was when it broke out. And so I think we need to see that 25.5, 25.75 breakout, and it should kickstart a bigger move in silver. And remember, investors are driven by greed. And so when we get that breakout, that's where everyone comes in and rushes in, and price goes crazy to the upside essentially.
All right, I guess since we touched a little bit on Bitcoin, how do you see Bitcoin doing? It's had a bit of a bumpy ride as of late.
It has. It has. There's no doubt about it. And I think honestly, I'm still in the camp that this is a bear market in crypto. A lot of people have gone in the bull market category. I am not a believer in that at this point yet, mainly because of the price action. I mean, if you look historically at Bitcoin in past cycles, we had plenty of bounces that were 100%, right? And so you can't really say like, oh, here we've bounced 100% from this 15 to 30,000 level, and now we're in a bull market when historically that's pretty normal in a bear market for Bitcoin. Now, having said that, you even zoom in, right? And right here, this was where Ripple had that news. The SEC, the judge's decision went in favor of Ripple. We popped on it, and then literally in one day we erased those gains. That is not bullish price action. And then even over here, this is where the grayscale news came out. We popped up, and in 2 days we reversed that. And so price action to me is the most important thing. And when you see gains, good gains on good news given up that quickly, it still tells you, and to me at least, that we're in a bear market price action. Now, does that guarantee we're going to break 15,700, 500 area, which is the lows? It doesn't guarantee it, but it just tells you that the price action is probably going to settle in here and chop around this area for a little bit longer before we get in a bull market.
Gareth, I want to go back and touch on something that you mentioned about the Fed and how it seemingly doesn't have a recession on its radar anymore. You think it's going to get back to that 2% inflation target, or are we going to see that 2% become 3 or 4% and have a different, as they say, a new normal?
Yeah, I do think it's going to be a new normal, right? So the Fed obviously is playing hardball because if they move the goalpost already, then we're in a lot of trouble. The market will right away adjust. But my guess is 3% will be their new goalpost. And what we'll see is, and we're almost at that 3% if you take out core. I mean, core can fluctuate quite a bit. But again, it looks to me like you're now in a scenario where when things get troublesome, inflation is probably still around 3%, and the Fed will be forced to probably stimulate again by either lowering rates or printing money. So I do think that the goalpost has moved now. The Fed just isn't ready to admit it, because once they admit it, the markets will adjust immediately to expecting that, and they don't want that to happen yet.
Right. Hey, Gareth, do you think the economy is ready to hear the Fed take a pause, or how do you think the economy would be? Let's say even if the Fed starts to go downward a bit more, and we see that cheap money come in, will the economy be able to take it?
Yeah, it's going to be interesting because, again, my biggest concern with that is where is inflation when easy money or lower interest rates come back in? Because right now we've brought inflation down, or the Fed has brought inflation down by restricting the money supply, right? Higher rates lock up money in the banks or in treasuries or things like that. But what happens when we're still at 3% inflation and they start printing again and the money starts flowing again? Do you see inflation then jump quickly to, let's say, 10% or 15%? And what's interesting is that, in fact, if you go back to the 1970s, 1980s, that's exactly what happened. The Fed kind of came out too quickly, and inflation then surged even higher on that next leg up. So the Fed has to be really careful. And the question is going to be is how much pain is the Fed going to be okay with the economy taking and unemployment taking before they step in? And they have to be very aware of what happened historically, because it will happen again if they loosen too quickly.
Yeah, right. I think that word pain and unemployment starts to ring louder and louder because with the Fed, their mandate being maximum employment and price stability, it seems right now they're working on that price stability part. But how do you see that maximum employment part going, especially if, let's say, the Fed does, let's say, throw in cheap money again, and then people starts that velocity of money picks up? You think jobs are going to be on the line?
Yeah, and I think that's such an important point because the Fed has had it relatively easy up till now, where the labor market has stayed strong. So they're only having to focus on price stability. But what happens now, and we're starting to see this, the latest non farm payrolls came out last Friday, and we saw that basically what we're seeing is now more people are being forced to come back and look for work. So it's not like a lot of people are getting laid off, but we're seeing people having spent down their COVID savings. We're seeing people being forced to come back into the labor market and start looking for jobs, and thus the uptick from an expected 3.5% unemployment to 3.88% unemployment. And I think, again, that is a precursor. It's showing people are running out of money. We know the credit cards are being run up into $1 trillion debt. And so at some point, employment is going to really struggle. And the question is, does at that point the Fed have price stability already locked down? I don't think they do. What we're seeing in oil, what we're seeing in other commodities, they probably don't. And that's going to make it even trickier for the Fed when you have unemployment spiking, but also prices not fully stable yet.
Right. And I mean, I guess when you throw in that dollar strength, or let's just say dollar demand waning with things like de-dollarization, I mean, where do you see personal income and personal spending going?
Yeah, I mean, income wise, I think it's going to start to plateau a little bit, just because, again, as the economy weakens, people that are looking for a job, there's not as big of a demand. So they're not going to be able to command the salary increases that they could during and just after COVID. Now, on the demand side of spending, let's say, that's where I think we could be looking at a big drop off. And I think you're already seeing that. Used car prices are collapsing. We're seeing a lot of these kind of metrics for price starting to suffer because demand is starting to wane. And we even saw consumer confidence recently take a little bit of a tumble, which is showing that the consumer is just beginning to feel the pressure. And also, I would just point this out, is that the Fed has hiked rates the fastest they have ever hiked in history, right? And also, we have to look at the fact that the Fed now is in a position where, they're looking at the economy and saying, okay, we raised the Fed funds rate here, but how long until that full effect is felt? And we have to remember as a society that it's a 6 to 12 month lag. So really, if you want to know how the economy is acting, go back 6 to 12 months. Where was the Fed funds rate? And you have to remember that there's still a lot more hikes that are going to ripple through the economy in the next 6 to 12 months.
Right. And along with this, we're seeing central banks continuing to buy gold hand over fist. Gareth, with all these narratives of the economy is doing better, soft landing or no landing, why, in your opinion, do we continue to see central banks loading up on gold?
I think it's that they know. I mean, if I'm aware of what's going on, I have to believe that when you get these smart individuals all together in a room, that they're fully aware. And I've said this from the very beginning. I'm a big chart guy. I follow the charts. The charts have been telling me stay bullish is on gold, silver, metals, commodities in general. But you have to say also, you could just simplify it down to say, hey, look at what central banks are doing all around the world. If they're the ones with the printing presses and they're the ones buying all this gold, probably means we as individuals should be buying gold as well.
Right, that's something we always say as well. I mean, if we have that printing press and we can create all the money we want, why are we buying gold then? Um, so I guess things are kind of coming full circle here. I mean, where do we go to protect the value of our money? Let's call it wealth protection.
Yeah, so I mean, I'm a big fan of diversifying, obviously. I think that's important. I don't have a lot of long positions in stocks right now, as again, I am worried that this bounce is very reflective of what we saw in 2000 with the dot coms. You had this big rally after the initial drop before the next leg lower. We saw this in the S&P in '07 into '08 and into '09 as well. And so I'm very concerned that this move on this narrative of no landing is influencing buyers of stocks to push things up where they shouldn't be. And there'll be a surprise when we do slip into a recession. But I do think that there are other places. Like you could definitely be looking at metals. In fact, palladium, it's not quite there yet, but I will show a chart on palladium. I have a very big technical level here coming up at around $1,150, right? There's a big pivot point going back to 2018's high. So I think that that's an interesting level. I mean, you look at the chart on palladium, it's coming dramatically from these highs here. And even on platinum, we can even talk about platinum as well. And platinum is hovering in this channel in the lower end of its longer term range. And if this can break above 1100, you get a big breakout on platinum. And I could see this thing north of 1300 as well very, very quickly. So I think the metals are a place to be. Eventually, Bitcoin is a place to be. I just am not quite convinced that the lows quite are in yet. And then again, if you want to play in the stock market, just look for defensive names. I would say like, one of the charts that I'm intrigued by is WBA right now. It's been hammered dramatically down. It's very much out of favor, but pays almost an 8% dividend. And so, I like to buy stocks when everyone else hates them. Walgreens is a household name here in the US, at least, and you are into some major support down here. So, again, be selective. Like, I'm not the type to be chasing NVIDIA up here, especially with the competition from the other chips that's coming in. I'm much more likely to look at dividend paying stocks that have been beaten down, that are out of favor. So, hopefully the downside is somewhat limited, plus they pay that dividend.
Right, that's a great point about wanting to invest in things when they are actually unloved. Gareth, what advice or just sentiment, let's say, no financial advice given out here, but what sentiment or opinion would you give to investors right now who are looking to get returns yet at the same time have a bit of safety considering things like the bricks coming up and getting stronger, things like dollar demand.
Yeah, I mean, I think again, diversification is super, super important. I mean, you don't want to have all your eggs in one basket. I'm actually a big fan of charts like the EWZ, which is the Brazilian stock market. I think again, if you look at this chart pattern, this is going back to 2008 highs, right? And since then, if you look at this in comparison to the U.S. markets have gone much, much higher than that 2007 high, but we haven't seen that in Brazil. And to me, they're a commodity haven. We know that they have lots of reserves, lots of things like that. And so you're looking at a chart here that looks to me like it's getting ready to break out of this wedge pattern, which would be very, very bullish. So I think, again, I wouldn't be all in on the U.S. I'd be spreading it around the globe a little bit, knowing that, like you said, BRICS is starting to become a bigger, bigger thing. I think you want to be in some metals, in some foreign names, some foreign stocks, and just really also have some money on the sidelines to deploy when the right opportunities come up.
All right, some great advice there. Gareth Soloway, before we head out, can you let the viewers know how they can follow you and also the services that you provide?
Wonderful. Yeah. So you can find me at inthemoneystocks.com, where I have a service called Verified Investing Alerts. I put out crypto signals. Well, not crypto as much, but more so stocks and commodity signals as well, levels to buy, levels to sell. And then I do a daily video. And then you can always follow me at verifiedinvesting.com, where I do a lot of education. And lastly, I'll say YouTube as well as Twitter. Just be careful of fakes out there, folks.
Yeah, absolutely. And gotta say, if you have never went over to Garrett's YouTube channel, it's quite the educational experience there. So, Gareth, I appreciate the time, and I hope we can do this again soon.
Thank you so much. It's been a pleasure.
That was Gareth Soloway sharing his view on the economy and precious metals. To see more of Garrett's work, please visit www.inthemoneystocks.com. If you like this video, please do subscribe, share it with friends, and give us a thumbs up. All are greatly appreciated. Audio-only versions of this interview can be found on iTunes and Spotify.